Nobody has been to more podunk towns in this country than Donald Trump. No one. No one in the history of America has been to more podunk, rundown towns that are been left behind economically by all us white collar wearing Wall Street people on the coastal elites.
He's talking about the Federal Reserve's future composition, specifically the likelihood that by next year, the Fed could be dominated by Trump-appointed members. If the administration successfully appoints new governors and replaces regional Fed presidents who resist regime change, we could see a significantly more dovish central bank, one aligned with the administration's push for aggressive economic growth. Dale emphasizes that we can agree or disagree with the levers being pulled, but we cannot ignore the direction. A Fed aligned with the White House's desire to engineer an economic boom would prioritize growth over inflation control, setting the stage for looser policy in the years ahead.
We think the administration is pulling some levers that are we can agree. We can agree or disagree with the levers they're pulling, but ultimately you have to focus on the destination as an investor. The destination is a Federal Reserve Board that is likely to be a majority of Trump appointees by this time next year. And if they get that done by, let's say, February, when the regional Fed presidents get ratified, then it could be the case that some of them that don't agree with the administration's desire for regime change at the institution get punted and replaced by folks who do agree with the administration's desire for regime change. So we could be talking about a Federal Reserve this time next year that is significantly more dovish in favor of the administration's desire to create an economic boom. And we would fully support that. 100%. And I say this all the time. I mean, nobody has been to more podunk towns in this country than Donald Trump. No one. No one in the history of America has been to more podunk, rundown towns that are been left behind economically by all us white collar wearing Wall Street people on the coastal elites. And of course, he has a sense of urgency with regards to trying to fix the K-shaped economy. Now, we can argue over the steps they're taking. We can argue over how they're taking the steps. We can argue over the general chaotic nature with which they're legislating policy. But one thing we cannot argue over is the fact that they say what they're going to do and then they go do it. And that's been very true for this administration the entire time. And so this is why we have so much steadfast belief in our Paradigm C theme, which we authored back in April, that's kept us, 100% bullish across global Wall Street, because we understand that they're trying to engineer an economic boom, and legislating very obviously, in our opinion, needed regime change at the Fed is a very clear and easy lever for them to pull. I initially covered sort of all the emerging economies before I started covering all the global economy. And one thing I learned very quickly from covering China is that, hey, these guys in Beijing tell you exactly what they're going to do, and then they start doing it. And when you think about sort of these command and control economies, and that's very clearly where we're moving in the direction of in the context of this fourth turning and having a fourth turning inspired president, someone who understands the fourth turning and is obviously legislating fourth turning style change, you have to just take them at the bare minimum. You can't fight what they're saying and fight what they're trying to do. You can disagree with it. Go disagree with the dinner party, go disagree with the cocktail party, go disagree with the golf course, but do not disagree with it in your portfolio, because you're going to get left behind by the markets. So getting into this chart here. So you call out something that is really what I think is kind of the real key driver of the non-recovery in the housing market, which is this historically elevated spread between the marginal mortgage rate and the effective mortgage rate. The marginal mortgage rate being the mortgage rate in the market that you would have to pay if you bought a house today, and the effective mortgage rate, which is the mortgage rate that everyone kind of has on a weighted average basis. And that spread, so the marginal mortgage rate's at about 7%. The effective mortgage rate is about 4%. So you're talking about almost 300 basis points a spread between those rates. And so folks who have mortgages don't want to sell their houses because they're going to wind up with a much more significant mortgage payment, which ultimately forced them to have a much smaller, force them to downsize in houses and kind of step back from a lifestyle perspective. So this has created a real stasis in the housing market. If you look at the chart at the bottom panel, the blue line in the chart on the bottom panel shows existing home sales. We've been troughing along financial crisis type lows in existing home sales for multiple years now. Like, we've basically had a financial crisis in the housing market for multiple years now. So this is to our friend, Scott. I know Scott, Treasury Secretary Scott Bessent for many years. He's obviously now the Treasury Secretary after being a longtime client. Scott is now coming out and saying, hey, we might declare a national emergency in the housing market. And in our view, that will give them more scope to, I guess, find more creative solutions to address this problem.
The US government is running huge deficits, around 6% of GDP, and rolling over nearly $10 trillion of debt in the next year. Combine that with the Fed's balance sheet policies, and you have Uncle Sam sucking up an enormous share of available capital, $11 to $12 trillion in the next calendar year alone. This capital drain crowds out private borrowers. That's why spreads in mortgage markets and corporate credit markets are so elevated. There simply isn't enough capital to go around.
Facilitate a lot of transactions in the existing home sales market because, part of having an assumable mortgage, you need to also be able to move to a place where there's an assumable buy. Like you basically need to have a daisy train of assumable transactions for that to really work at scale. Not saying that it can or it can't, but that is definitely one lever they can pull. And another lever they can pull is having some sort of federal backstop for assumable mortgages. Like say, basically hey, Fannie or Freddie, or you create a third entity that comes in and says, well, we'll pay the spread between the assumable rate and the marginal mortgage rate. These are all things that they can do. Now, this stuff's not going to come tomorrow, next week, or next month, but the reality is you have an administration that has a high sense of urgency and a real staunch sense of alacrity with regards to, addressing what they feel is an economic crisis for all the people that have been left behind, consumers and businesses that have been left behind in the prior kind of neoliberalism regime. Not to say that what they're doing is going to work, but I think it's way too early in paradigm C to suggest that it is not going to work in our view. So if you look at the second panel in this chart here, there's about a 260 basis point spread between the 30-year fixed mortgage rate and the 10-year nominal treasury yield. That's essentially an all-time high. I mean, we were higher in recent years. We're up at like 350 basis points a couple of years ago, but it's still, the current level is still essentially at an all-time high. And so what it's telling you is that there is not enough capital going to the mortgage market. And this is part of the reason, this is a symptom of fiscal dominance. When you have a sovereign that needs to capitalize 6% of its GDP year after year after year in incremental budget deficits, or rolling over, right now we're rolling over about, roughly about $10 trillion of debt that's coming due in the next year. Plus the Fed obviously is continuing this ridiculous balance sheet runoff policy. You essentially have, a real big sucking of capital out of the economy that's going to Uncle Sam right now, to the tune of about 11 or 12 trillion dollars over the next calendar year. And so what it's doing, it's crowding out the effective stock of savings, both domestically and globally. If you look at household sector savings or corporate sector profits, it's essentially gobbling up a much higher share of that on a go forward basis. And because it's gobbling up a much higher share of that, you go back to the chart on slide 3 where we show the refinancing risk. Part of the reason we have such elevated refinancing risk, not just in the MBS market, but in the corporate credit market as well, is because there's just not enough capital going around. The government is hogging it all in this fiscal dominance regime. So in our view, and this has been consistent with a Fed policy in previous four turnings, and quite frankly, it's consistent with monetary policy, how it's been implemented across dozens of societies, across hundreds, if not thousands of years of data, is when you have fiscal dominance, you tend to see financial repression and monetary debasement to offset that, because otherwise you're just going to run out of money. Like you need financial repression and monetary debasement in a fiscal dominance regime. Now, the Fed can sit there and argue to its blue in the face whether or not fiscal dominance is appropriate or not. But guess what? This is what the people elected. This is what the people elected. They elected for this. They went to the ballot in November and they said, we want this. And so it's not the Fed, in my opinion, it's not the Fed's job to stand in the way of that. It's the Fed's job to make that as easy to digest as possible for the economy, so that we get positive economic outcomes. And in our view, positive economic outcomes does not end with an arbitrary 2% inflation target. It ends with positive, real median wage growth. That's what people really want. That's what makes people happy. If you go back and you study all these psychological studies from the Netherlands and all these other places where people are actually happy, what they tell you in those studies is people's lives getting better incrementally is what makes people happy. And so ultimately, it's not 2% arbitrary inflation target is what makes people happy. Nobody gives a damn about a 2% inflation target. What they want is real median wage growth.
Whether it's housing interventions, dovish Fed appointments, or deficit-driven fiscal policy, the levers being pulled all point toward one thing: an attempt to deliver growth at all costs. And if history is any guide, that path will be messy, inflationary, and disruptive, but also potentially lucrative for those who position correctals.